If you're an Indian thinking about investing in Dubai property, you have probably heard this already. What about tax? What about TCS? What if the IT department sends a notice? What if my money gets stuck? Here is the truth. Dubai investing is not risky because of taxes. It is risky only if you don't understand the rules. In the next few minutes, I will show you exactly how Indians legally send money, how tax really works, and why, if done right, Dubai can actually be simpler and more efficient than investing back home. And yes, I will also break down the 2026 budget changes that made this even smooth. Over the last year, we have seen a big shift. High net worth Indians aren't looking only at Mumbai or Bangalore anymore. They are looking at Dubai and Ras Al Khaimah. Why? Because the India-UAE corridor has quietly become a tax-efficient, wealthy highway. But to play this game properly, you need to understand just three things: LRS, TCS, and DTAA. Don't worry, this sounds complicated, but it is actually very simple. And thanks to Budget 2026, it just got easier. First, let us talk about the biggest fear: sending money. Every Indian who invests abroad uses something called LRS, Liberalised Remittance Scheme. It would sound technical, it is actually very simple. Under LRS, each Indian resident can send up to $250,000 per year abroad for education, for investments, or even for buying property overseas. This limit resets every year, and for normal transactions, you don't need special RBI permission. Now, here is the part most people don't know. What if the property costs more than $250,000? For example, if you want a Golden Visa immediately and you have to go for a ready property and you are looking at a property of around 2 million dirhams. That is way above one person's LRS limit, right? You don't have to stop. Your family can pool their limits too. You can send 250. Your wife can send 250, your parents can send 250 each. So a family of 4 can legally send up to $1 million. Here is a catch: as long as everyone is a co-owner. This is clean, this is legal. This is already how large Dubai investments are being done by Indians. Now comes the scary word everyone panics about: TCS. From Budget 2026, here is the rule. If your remittance crosses 10 lakhs in a year, bank may collect 20% TCS on the amount above that. Now listen carefully. TCS is not an extra tax. Think of it like an advance tax. That money is yours. You either adjust it against your tax liability or you claim it back as a refund when you file your ITR. So think of TCS like this. It's not a cost. It is just a temporary blocked cash flow. TCS should not scare you away from UAE investing. It's a timing issue, not a wealth issue. Also, Dubai properties often come with concession-linked payment plans or mortgage options. So your entire money is not stuck on day one anywhere. Bottom line, smart investors plan cash flow around TCS. They don't let it stop them from chasing 8 to 10% rental yields in Dubai. Now the big question: will you be taxed in both the countries? India and UAE have something called DTAA. Double Taxation Avoidance Agreement. Simple meaning, the same income should not be taxed twice. If you own a property in UAE and earn rent, here is how it works. In the UAE, for individuals, personal income tax is 0. But if you're an Indian tax resident, you still have to report this income in India. In India, it is treated like normal rental income. But DTAA allows you to claim credit for any tax paid abroad. Since UAE personal tax is usually 0, the structure becomes very efficient. And here is the practical difference. In India, you may get 3 to 4% rental yield. In Dubai, you get 8 to 10%. So even after tax logic, the net math is still stronger. Now let us look about capital gains. What happens when you sell the property? In the UAE, for individuals, capital gains on property is 0. But if you're still an Indian tax resident, India may look at your global income. This is where DTA helps again. It prevents double taxation and allows credit. Your residency status at the time of sale matters a lot. If you're an NRI, there is usually no Indian tax on that UAE sale. But if you're an Indian resident, then long-term or short-term capital gains rules can apply. It is just similar to selling a property in India. But even here, remember this: Dubai often gives higher appreciation and higher rental income compared to many Indian markets. Now let us talk about staying 100% clean and stress-free. If you are an Indian tax resident, you must disclose all foreign assets, including Dubai property, in Schedule FA of your ITR. If you don't, penalties can be very serious, and it is not worth the risk. Clean reporting equals peaceful sleep. The good news is, in Budget 2026, it introduced a one-time window to fix past small disclosure misses with lower penalties. In case if you have assets abroad, you have to just declare it. So if you see, now the system is actually becoming more practical, not more scary. It's getting transparent. So why do so many investors prefer UAE over India for cash flow assets? You know that in the UAE, personal income tax is 0. Rental income for individual is 0. Capital gains on property for individuals are also 0. Corporate tax is 9%, but small business relief and free zones often mean 0% till 2026 for many. In India, personal tax can go up to 30% plus surcharge. Also in India, rental income is fully taxable. Capital gains are taxable. Compliance is heavier. That is why many investors say Dubai doesn't just give you returns. It gives clarity, stability, and predictability. So here is the truth. If you plan remittance properly under LRS, understand TCS is just cash flow timing, use DTAA correctly, report assets cleanly, and structure residency smartly, Dubai becomes not just attractive, it becomes logical. And if this video helped you, subscribe.